What's up, guys? Riz here. Today I'm here to talk to you about taxes, something that many people have requested for quite some time on shedding a little bit of light on how taxes work. Before I go any further, a disclaimer, okay, very clear and simple. I am not a CPA, I'm not a tax specialist, I'm not your accountant or tax specialist, okay? None of this is advice on what you should do because everyone's tax situation is different, but there are certain principles and things that, generally apply and something you should be aware of. At the very least, you have a better understanding of how taxes work. Keep in mind that it's not going to be specific to you or anyone, right? It's very broad because your individual income and tax situation is specific to you. Where you live makes a difference. What state or province you're in the country that you live makes a difference. And of course, things change, right? As time goes on in terms of rates and taxation policy. Okay, so keep that in mind. It's something I want to make very clear before we get any further into the content. So in this video, I'm going to break down briefly a few things. One, how tax brackets generally work. There's a lot of misconception, a lot of misinformation, and a lot of people have no idea how taxes work. This is not a tax course or anything like that. It's a very brief and general video just to shed some light. So don't take it as some kind of tax planning advice specifically for you, okay? But do take it as general information that you should definitely be aware of. So before we go any further, I do want to say that the principles that I'm going to be talking about and kind of the rates of taxation and the tax brackets are going to be specific to the US. Why am I doing it for the US? Because that's where most of the people who I converse with and many of the students, members, and effectively generally majority of those that seek my counsel are from the US. So I figured it makes most sense to cater to them. Of course, I know there's many of you all across the world, but I cannot simply touch on, individual tax rates and whatnot for each and every country. There's many of you that I know are from about 35 different countries that I'm aware of. So, I'm not going to be able to go into that each. So it's going to be generally for US specific, but the concepts apply to whatever country you're in with some variation, right? Every country has some slight variations. With that said, I'm in Canada, so very similar concept to the U.S. Tax system and other countries as well, but our rates differ. And we have a little bit of a difference between how capital gains are taxed. So I'll briefly touch on that too. So without further ado, let's get into the first sort of image I want to show you is the U.S. income tax brackets, all right, for 2020. This is the federal income tax brackets that you'd be paying for 2020 year. Okay, and remember, these are subject to change and they were different if you look back 5-10 years ago. But ultimately, here they are. Let me explain to you what we're looking at. Okay, so this is for single filers, meaning if you're an individual and you have an income, okay, remember, tax is a very in-depth topic, and this is not a tax course, but generally speaking, your marginal tax rate is going to differ based on how much money you make. There's this misconception, Riz, I'm making $200,000 and my tax bracket is 32%, let's say 32%. I'm going to pay 32% of my 200,000 income. No, you're not going to pay 30% on all the 200,000. There's this misconception. People do not understand how marginal tax brackets work. So I'm here to demystify that, okay? So simply put, you can refer to this chart if you're in the US. It's super helpful. You can refer to this, save this video. But take a look at how this works. I'm going to do a brief explainer. 10% tax rate. If you make $0 a year to $9,875, okay, a year in net in your income, whether you're deriving it from a job or whatnot, okay, you owe 10% of that in taxes. So that's $987.50, right? That's for that first bracket, okay? But what if you're someone who makes, $40,000? How does that work? Okay, the average income in the US is about $40,000 US dollars. So before tax. So how does that work? So majority of the people are going to fit into this 12% tax bracket. Okay, so this is where most people are going to fit in. I know everyone's been complaining, oh, I don't want my taxes to go up, and depending on who's president and all that. I'm not going to get into the politics of it, but guess what? Regardless of what happens, you will not be significantly impacted regardless, because there's many ways of doing tax planning and tax strategy. So it's very important to have, if you're in a higher income bracket, you're making a lot of money, which is fantastic. You want to make sure you have the right tax planning, the right tax specialists that you have retained, because it's well worth the money. Remember, tax avoidance isn't illegal. Tax evasion is, okay? So the very key distinction, if you're using the IRS's or whatever, tax, let's just say legislator, tax sort of individual, in the case of the U.S., it's the IRS, but whatever tax kind of authorities there are in your country, you want to make sure that you're using their rules and being able to use them strategically, because that's not illegal, that's not a crime. Okay, avoiding taxes is not a crime, but evasion is, meaning you're not paying the taxes you should be. That's a crime. Okay, so tax is very, I know no one likes to pay tax, but it's a very important thing, because you are living in a free society. You're living in a society where you have a vote, or, again, I'm talking specifically to the US. You have many civil liberties. You have many things going for you. You have free speech, this, that. You shouldn't be sort of so bitter and sour for paying taxes. And I know a lot of people are going to disagree with me, and that's fine. I'm not someone who enjoys paying taxes either, but because of what I do for a living, and I'm fortunate to do well, it's part of the game. Does it mean I just give everything I can to taxes without any thought? No, right? You have to do it legally. You have to do it in the right method, using the right strategies. And I'm going to touch on those briefly. Okay, so back on track. 12% is what the average person is probably going to fit into. Again, your situation is different. So if you make between $9,800 to $40,000, again, the specific numbers you see there, you're going to be in the 12% tax brackets. How does that work? The first 10% of the tax rate is going to be $987.50. So you take $987.50 plus the 12% of the amount over $9,875. Okay, so whatever that is, let's just say it's like $31,000, give or take. Okay, $31,000. What you're gonna do is whatever you make. Maybe you're not making $40,000. Maybe you're making $35,000. Right. So you're gonna take the difference of $9,876. Okay, and $40,125. Then you're going to multiply that by 12%, 0.12, whatever that number is. Okay, whatever that number is, you are then going to add $987.50. That's going to be your tax without deductions. Remember, this is a very simple, general explanation of how you're taxed on the federal level or on the provincial or the state level. Okay, does not include tax planning, different tax strategies, deductions, expenses that you are able to write off. So that doesn't include all that. Okay, this is just simple one-to-one income versus tax paid. No deductions, no benefits, nothing in terms of deferring taxes or tax efficient accounts, not factoring that in. Okay, so it's not that bad. You're not paying 12% on $40,000 like people think, right? This is the beauty of the marginal tax rate. Understand how taxes work. No one has taught people, in my experience over many years of dealing with thousands and thousands of people across the world, I found there's a massive lack of education on how the basic thing that we all do in free society, which is pay taxes, right? Regardless of how much you make, we all at some point pay some amount of tax. So no one knows, or I shouldn't say no one, but most people have no idea how much they're paying and where it comes from and why they're paying what they do and how to effectively manage their taxes, right? So that's how it works. Let's do another example. What if you make, and you're fortunate enough to make $80,000 a year, okay? So what happens then? What happens then is you take, okay, because you're in the third tax bracket, you're in this one, right? That's your marginal tax bracket, okay? So remember, not all of the $80,000 that you make is taxed at 22%, right? So I'm going to bring up the calculator tool just to kind of briefly show you if we are doing $80,000 a year in gross income, okay, what we do is you wouldn't be doing what average person is going to think, okay, I'm going to do 22%, right? I'm going to multiply that by 22%. Oh my God, out of my $80,000, I'm paying $17,600 in net tax, right? No, that's not accurate. That's not accurate. It's not that simple. What you do is the first 98.75, you're paying 10%. Then the amount between 98.76 to 40,125, you're paying 12%. And then the remainder, you're paying 22%. Okay, so I've outlined the numbers here for you. So you take the difference between 40,126 and whatever you make, right? So 80,000 subtract the 40,126, and that's 39,000 excess. So only $39,874 will be taxed at the actual 24%. Okay, right? Remember that. Sorry, 22%. Okay, only that's going to be taxed at the 22%, not all of the 80,000. Okay, so what we do is we do 4617 and 50 cents, $4,617.50, plus we add the tax for this. Okay, so we're going to do 4,617 plus the 22% of this. So what's 22% of 39,874? That's $8,772.28 in taxes. Okay, plus the 4617 and 50 cents. 13,389. Notice that number is quite a bit different. Okay, quite a bit different than what initially was what someone would think they're paying. So 13,000. Excuse my writing, I'm using a mouse here. Okay, 13,389 is the total tax someone's paying on $80,000 of income, depending on their marginal tax rate. Remember, this does not include, expenses, certain write-offs, certain deductions. Okay, so 13,389. Compare that to what someone thought they were going to pay, which is, 22% of 80,000. Right? 22% of 80,000 is what people thought they're going to make originally, and that's not accurate. Okay, so let's do the math. 13,389. Compare that to what someone would think. Okay. See the difference? About $4,300 is what they overthought that they were going to pay, right? They thought they overestimated. Okay, $4,300 or so. So that's the beauty of the marginal tax rate, right? It's important to understand how it works. So why am I telling you this? Because this is important to know before we can get into what's known as capital gains tax. Capital gains tax is when you sell something, okay, that more than what you paid for. Okay, so this, remember, it doesn't just apply to stocks and trading, whether it's stocks, options, whatever. It applies to real estate. If you have a real estate income property, or rental property, or investment property, it applies to that as well. So keep in mind that it's not just for stock. People are like, oh, but real estate this, real estate that. Yeah, there are some tax benefits to having investment properties and real estate and whatnot. Don't get me wrong, but it's not some, get rich quick scheme, or isn't something that you use to bypass taxes. No, if done right, you can manage the taxes that you're going to pay and be efficient with it. But that doesn't mean, you're not going to pay any taxes because if you do real estate. Oh, and taxes are so big part of the thing when you're actually trading stocks. No, you're going to pay taxes on both if you make money, right? If you make money. So let's break down how capital gains work. So you have two things in the U.S., okay? The tax structure in the U.S. is a little bit different in terms of capital gains. So the way it works is you have short-term capital gains. Short-term capital gains are anything that is held for less than a year. So if you bought stock ABC, okay, for $50 and you sold it for $75, that's a $25 gain. But if you did it in less than a year, that's going to be constituted as short-term capital gains. If you did it over 1 year, so you held it for over a year, okay, as long as it's above a year, it could be 1 year and 1 day, or it could be 1 year and 10 days, 20 days, as long as it's above a year, that is long-term capital gains tax, okay? And they work a little bit differently. I'll tell you briefly how it works in Canada. In Canada, it doesn't matter how long you held it for. There's just a flat, simplistic tax rate on capital gains. And the way that works, in fact, Canada has a little bit beneficial tax rate to capital gains than the US. And that is, we simply take 50% of the net capital gains and then we apply it to our marginal tax bracket as income. Okay, and this is the marginal tax bracket, right? That you're seeing here, right? This is the marginal tax bracket that you're seeing, right? Obviously, this is for the U.S. But let's bring up the short-term capital gains. Here it is. Okay, here it is. Take a look at this. This is for the 2019-2020. So remember, this is based on different parameters. If you are married, if you're not married, you're single, you're married, filing separately. We will focus on this. Okay, we'll focus on this. All right, this is the part we're going to focus on, the first single payer. So if you're making money, how do capital gains work? People think that, oh, Riz, I made $100 on this trade. Okay, that was a swing trade and it was open for 2 weeks. I made $100 on it. Am I going to pay tax on it? Well, you don't know the answer to that yet, because you have to pay taxes depending on your annual net capital gain or net capital loss. Making money in a single trade here and there doesn't apply. It has to do with the net. So if you made $50,000 trading, okay, this year, net minus all the losses, then that's your net capital gain, right? Not what you did on one trade. It's not a trade by trade basis. It's for the full year. What you did for the full year is what matters. All right. So if you made, let's just say $50,000, how would that work? So, and this is for short-term capital gain, meaning this is because you're actively trading, you're swing trading. Okay. So you made $50,000. How does that work? If you made $50,000, okay, you'd fit somewhere in here. Okay. The brackets are for 2020. Okay. The brackets are for 2020. So take a look at the brackets level. You made $50,000. This way you're going to be fitting into, all right, the 22% tax bracket. So what happens is, if you made $40,000, okay, in income from your job, plus you made 50, well, that's great. You're making more trading. Okay, fantastic. You're making more trading. So that's a total combined tax rate of $90,000, right? That's a total $90,000 income, but it's separate because you have to apply, okay, the $50,000 you made trading separately. So if your income is between $40,000, $126,000 to $85,000, well, how does that work? You're going to take that $50,000 because it's short-term capital gains, and you are applying it to your regular marginal tax rate. Okay, so that's going to bump you up into a different tax bracket, 24% tax bracket for the marginal rate. Okay, same way how we did this income tax calculation, it's the same way. It's like that 50,000 is taxed as income. Okay, it's taxed as income. It's taxed like it's in your ordinary income. What happens if you made money? Remember, net capital gains at the end of the year because of closing trades. If you have a trade open and it's making $20,000, you do not count that towards your net capital gain unless it's closed. Remember, unrealized gains do not count. You have to close the trade for it to count. Same way with losses. If you hold a loss and it's not closed, it's not realized yet. That's why in your trading account it will say realized gains, unrealized loss, realized loss. Okay? It's important to differentiate that. If you have a position open and you haven't taken the profit on it and you haven't taken the loss on it, you can't include that. It's only for realized gains and losses. You total up your realized gains and losses, and that end number is what your taxable capital gain or capital losses. Okay, I'll touch on what happens if you had a loss in the year. But for the long term, what happens if you held, again, we're going to deal with this single area. If you have long-term gains, then they are taxed, okay, in a more efficient manner. They're taxed depending on your income, okay? If you make less than $40,000 and you had a long-term capital gains, look at that, okay? You're going to pay 0%. So notice how there's more preferential. People think, oh, I'm paying a 20% flat rate on capital gains if that I had long term. No, it's up to a 20% rate. Okay, not 20% flat. It's up to a 20% depending on your income. So what if you had an income of $39,000 or $40,000 to $441,000? Okay, well then you're in the 15%. Okay, you're going to be paying 15% on that capital gain. Still quite a bit efficient than compared to what your income is. But that's going to depend how much money you make, right? This is why it's so specific to every individual, right? Let's move on to some basic concepts that you can apply to mitigate and decrease some of your capital gains tax. Okay, one, what you can do is if you have a position that you're sitting on, okay, it's a long-term position or maybe it's a short-term position, and we're getting to the end of the year like we are now. We're end of November almost, and what would you do? A lot of people are thinking about taxes because the calendar year is ending. What you need to do is, at this point, if you have a stock that you're losing $5,000 in, you haven't closed the trade yet, meaning it's not a realized loss, you might want to consider it, because what happens? What happens if you do that? You decrease, okay, your capital gains by that amount. So what if up until now, simple example, what if up until now you know that your net capital gains from trading has been $30,000, okay, so far. But you have this position that you're losing $5,000 on. And you're thinking, well, is it going to recover? What do I do? But your net capital gains so far is $30,000. At this point, remember, there's no right or wrong answer. But at this point, you might want to consider booking this loss. Why? Because this will decrease your net capital gains by $5,000, right? Because you took a $5,000 loss, so you subtract $5,000, and that's going to give you a net $25,000 gain. Okay, so notice how you decreased your net capital gain. All right, that's one way to do it. We call this tax loss harvesting. All right, this is a common strategy that people do, whether they're a single trader, whether they're a family office, whether they're managing millions or tens of millions, or there are a corporation, right, or a fund. Tax loss harvesting is something that it's not a secret. It's not something special. It's something that a lot of institutions use, a lot of individuals use. So it's something you should be considering, and something you should be aware of, because that's how it works. You can decrease. You're offsetting your gains, right? Let's assume that you didn't have a good year. You didn't have a good year, and your net realized capital gains is actually a capital loss. You're not making any money. Remember, this is net realized. This is after closing all the trades that you've closed, tallying them up. It doesn't include open positions. Okay? What if your net loss this year, it's been a rough year, is actually $20,000? Okay? $20,000. You're down $20,000 in terms of net loss. So you lost $20,000. You booked $20,000 in losses. Are you going to be paying any tax? No. You don't pay capital gains tax if you don't have any capital gains. Okay? But what if, on the other hand, you're thinking, I have a couple other positions, and you're bag holding these, and you're losing $3,000, okay, on one open position. Then you're losing another $2,000 on another open position. What do you do? Okay, do you see if it can recover? Yeah, perhaps you could. Or you could consider booking the loss. So that's a total $5,000. And you're going to then, okay, have another $5,000 capital loss. You total that up. That's minus $25,000. So you now have a $25,000 capital loss that you get to carry forward. Okay, again, there's some restrictions based on your income, but generally speaking, you get to carry that forward. The IRS will let you carry that forward. Same thing with the CRA for the Canadians that are watching this. You can carry forward your losses. So for many of you that that have been following me, there was one time where I took a $200,000 loss. I booked that loss. What did I get to do with that? Right? Let me clear the screen. I got to carry forward that $200,000 loss. This was a few years back. Okay, I did this knowing what I was doing. Okay, sorry, it's covering the rating. My apologies. $200,000 loss. What did I do? I got to book this $200,000 loss, okay, and carry it forward. So what if I have a $200,000 carry forward loss for the next year? Well, and then next year I make $100,000 in realized capital gains. I subtract that from the carry forward, right? So I subtract that from the carry forward, meaning $100,000 profit, right? I had for this year. So that's going to equal still 100,000 capital loss that's carried forward. So you get to carry it forward, even though I made $100,000 in capital gains. So again, this is an example. I still don't pay any taxes because I'm carrying it forward. I'm offsetting that original 200,000. Okay. Next year, what if I had a not as good of a year? Then what if I made $50,000 in realized capital gains? Okay. Well, then you take off another 50 from this, right? Again, I apologize for my writing. Running out of room here, but that's going to then keep you in a carry forward capital loss of $50,000. So you're still not paying any tax, even though you made $50,000 in net capital gains this year, or I should say, right? So again, just as an example, right? So you get to carry forward losses. Remember, depending on your personal situation, you want to confirm that, because with Canadians, we have a better tax efficient system for investors and capital gains. For you, you might be limited to how much capital gains or how much capital losses you can carry forward. You want to be aware of that, make sure. But something you look into, right? Tax loss harvesting, carrying forward losses. I'm not saying, it's a good thing to lose money, obviously not. But guess what? If you have some losses, you might as well book them if it makes sense for you, so that you get to offset any capital gains that you had. If you didn't have capital gains, you get to carry forward that loss up to a certain amount and then offset it next year. Hopefully when you make some tangible realized profits next year, you offset it, right? So that's how tax planning works for capital gains in stocks. Another thing you can do is, I say this in my courses, I say utilize tax efficient accounts. Meaning, if you're in the States, utilize your IRA, Roth IRAs. Remember, they're also specific to you. Depending on how much income you make, you have contribution limits. But utilize those accounts. Contribute to them, right? Trade and invest in them. And whatever you make is going to be tax efficient. You may not be paying any taxes on any gains in there, right? For Canadians, you have something called a Tfsa and an Rrsp, right? So both are tax efficient accounts. Again, both with their pros and cons. There's no reason not to max out your Tfsa. Just like for anyone in the US, there's no reason not to max out your Roth IRA, and try and max it out. Again, depending on your income situation, use these accounts for investing. Use these accounts for dividend income, because there's no tax on that, right? So the government, the IRS, the CRA, whatever tax kind of institution is in your country, you may have different accounts like this, right? The UK has an ISA account, right? That's something similar. So many countries have these kind of tax efficient accounts that their citizens can use to save money on taxes. It's legal. It's given to you. The websites for these, institutions, whether it's the IRS, the CRA, whatever, they're the ones who are telling you to, but many people don't know. I still get so many questions. Riz, what's an IRA? What's a Roth IRA? How does it work? And I'm like, okay, it's a messed up situation where the financial education just isn't there for people. So please consider that. I hope, it's helped you. I know we've touched on quite a bit. I know that not all of it is very easy to digest, but I promise you that it's not as complex as many of these places and tax specialists and accountants want you to believe. They want to retain your services. And of course, you should have a good accountant, a good CPA or whatever, but it doesn't mean that it's rocket science and you can't figure this out yourself, right? I would definitely consider making sure that you're generally aware of how taxes work. Leave the specific details and deductions and what you can write off, what you can't write off. Let that be your accountant's and CPA's job. But on a broader top level, you want to know how much you make. You want to know how much, you're going to be taxed. You know how much that's going to end up being. That's something you want to be aware of. And most importantly, you want to understand how the tax brackets work, because it blows my mind how many people have no idea. They just think that, oh my God, I make $200,000. I'm going to pay, a 50% tax rate on this. So there goes $100,000. The government's stealing $100,000 of my money. No one wants to pay taxes, but no, you're not paying a 50% tax rate on 200,000 or whatever your tax bracket is. You're not paying 40%, right? You're not paying 80 grand on 200,000 of income. No, it's structured. It's tiered. You have to first bracket, okay, then goes to the second, whatever's remaining goes to the third, so on and so forth. Understand how this works. Rewatch the video. Hopefully you like it. Let me know if you enjoy the video. Like, thumbs up, share, comment, and let me know, right? Because I'm hoping that, these videos, these instructional, educational videos help you. And remember, this is not tax advice for you. This is not, anything that you should be just citing and saying the IRS, well, Riz told me to do this. No, please don't do that. All right. Well, have a great, wonderful evening. Ciao.